Welcome to our deep dive into the potential of holiday-let investments in Portugal compared to Spain. While many buyers may start from a place of personal preference, our focus today is on what the evidence says about the investment viability of each destination. We will be comparing a Portuguese villa to a Spanish apartment using a structured approach to evaluate their investment merits. This approach ensures we look beyond the surface to the core financial and operational data that drives long-term success. Throughout this walkthrough, we'll use our specialised tools to screen these opportunities properly. Let's start by understanding the fundamental differences between these two iconic destinations. Portugal often evokes images of villas, scenic Atlantic coastlines, and relaxed lifestyles. On the other hand, Spain brings to mind vibrant apartments set in Mediterranean resorts and bustling communities. These narratives are not just appealing, they are crucial factors that influence guest demographics and management strategies. They also dictate seasonal demand patterns and the overall operational effectiveness of your holiday let. Understanding the local context helps in choosing the right property type for your specific investment goals. Whether it's the Atlantic breeze or the Mediterranean sun, each market offers unique opportunities and challenges. Your strategy must align with what these guests are looking for when they book their getaway. Now, let's assess specific examples to see how these differences manifest in the numbers. We're looking at a Portuguese villa priced at €475,000. It's a premium option with significant potential. In contrast, we have a coastal Spanish apartment listed at €325,000, representing a lower entry point. The villa represents higher initial costs and potentially more gross income, whereas the Spanish property demands less capital up front. However, the Spanish property comes with its own set of operational challenges that must be factored in. Recognizing these differences, operational structures and risk profiles is critical for making well-informed choices. It's about finding the balance that fits your risk appetite and capital availability. Let's dive into the financial foundations of these two scenarios, starting with our core assumptions. For our financial analysis, we start with the assumption of a 50% deposit and a 50% loan-to-value ratio. This leads to a €237,500 loan for the Portuguese villa and a €162,500 loan for the Spanish unit. However, remember to account for additional costs such as transaction fees, maintenance reserves, and working capital. These additional requirements elevate the overall capital requirement to approximately €575,000 for the Portugal investment. For the Spanish property, the total capital required comes to approximately €392,000. Maintaining a 50% LTV provides a solid buffer against market fluctuations and interest rate volatility. Using our comparison engine, we can clearly see how these different capital levels impact the starting point of the deal. With the foundation set, let's look at what these properties can realistically generate in income. Next, we evaluate income estimates. For the Portuguese villa, we're looking at a potential gross income of around €58,650. This is based on 170 booked nights at a €345 nightly rate, which is a standard illustrative scenario for this property type. The Spanish apartment, with an estimated 195 nights at €205 per night, could yield approximately €39,975. Of course, gross income is just the start. We must factor in essential expenses like cleaning, utilities, and management fees. After these deductions, we project pre-financing returns of €26,506 for Portugal compared to €19,679 for Spain. It's critical to remember that gross income does not equal cash flow. There's more to the calculation. Understanding the net position is what ultimately determines if the investment meets your requirements. Since we're looking at international markets, we must also consider the impact of currency dynamics. A UK investor may primarily think in pounds, meaning fluctuations in the euro could markedly impact your actual returns. Managing a property from abroad doesn't mean doing it all alone. local contractors are essential for daily operations. Clearly defining who manages specific responsibilities is essential to balancing your workload and expectations. Efficient local management is often the difference between a stressful asset and a successful investment. Investors should have a plan for managing exchange rate risk, especially when transferring large sums for acquisition or income. Staying informed about currency trends is a key part of the International Property Investors Toolkit. Now, let's take these numbers and push them to see how they hold up under different conditions. Conducting stress tests is vital for uncovering any potential vulnerabilities in your investment model. Assuming an interest rate of 5.75%, the financing costs would equate to €13,656 for the Portuguese villa. For the Spanish apartment, that same 5.75% rate brings the financing costs to approximately €9,344. This leaves us with estimated cash flows of €12,850 for Portugal and €10,335 for Spain. Analysing break-even points sheds light on how one base case figure can lead to misleading assumptions. What happens if occupancy drops by 10%? Stress testing gives you the answer before you commit your capital. Our Pro tools allow you to model these sensitivities instantly, providing a clearer picture of your risk. Before making any offers, you must move from assumptions to verified evidence. Before making any moves, the collection of thorough, verifiable evidence is absolutely indispensable. For Portugal, this might encompass comparable villa bookings and obtaining detailed insights from local management. In Spain, you would specifically need to understand community regulations and tourist licensing requirements. The strength of your evidence file should guide your decision-making process, not just the allure of the property. Our AI intelligence tools can help interpret this evidence, identifying conflicts or gaps in your assumptions. Never rely on a single source of truth. Cross-reference your data to ensure its accuracy. Let's wrap up what we've learned and look at how to take your next steps with confidence. In essence, the choice between investing in Portugal or Spain lies in the details of the evidence gathered. A well-informed buyer looks beyond the superficial charm of a destination, weighing the operational and financial facts. Your investment decisions must be grounded in robust analysis if you want to achieve long-term success. For even deeper insights and resources, we encourage you to explore our platform for your next deal. Whether you're just starting or managing a portfolio, our tools are designed to give you that critical edge. From detailed spreadsheets to AI-driven intelligence, we cover every aspect of the holiday let investment journey. Take the time to review your assumptions and build a strong case before you make an offer. Visit holidayletinvestor.co.uk today to start screening your potential holiday let investments properly. If you need more holiday let calculators, guides and deal checking tools, visit holidayletinvestor.co.uk.